All right. Hey, everybody. This is Collin with Freaky Fast Investments. And today you are with us on Brick by Brick, building generational wealth one single family home at a time. Our weekly podcast dedicated to you, our investors. And today, what we are going to talk about is our portfolio that we are getting ready to close in St. Louis and Cincinnati. If you've been following us for any period of time here, you've heard us talk about this, but I'm going to go a little bit deeper into our latest acquisition and how you can join alongside us by investing into this incredible deal. And so just a little background for those of you who may be hearing about this for the first time. So Freaky Fast Investments, if you're just learning about our team, we are a single-family home real estate investment company based in Fort Worth, Texas. And our goal is to be able to go in, find distressed single-family homes, renovate those homes, and turn them into cash-flowing rental homes. That's our whole model, what we do day in, day out. And our latest acquisition is going to be in St. Louis and in Cincinnati, Ohio, two markets that are in high need of affordable rental homes. Both of these places are home to a ton of blue-collar workers who are looking for an affordable place to raise their family, raise their kids, have plenty of space to let the kids play in the backyard, have all the bedrooms, and all the amenities of single-family homes without the headaches of home ownership. And so we're investing in these markets. We're getting ready to close on 100 homes in Cincinnati and 263 homes in St. Louis. Our current close date is December 10th, and so we're looking to raise additional capital into this deal. And it's going to be going into an investment fund we've already been raising for, our Asset Fund 2. And so today, I'm going to dive into our Asset Fund 2, talk about some of the returns we're projecting for that project and how you can get involved. So again, this is all with the goal of you joining us by December 10th to invest with us. And so here are the three reasons I want to encourage you to invest in Asset Fund 2 and get in on this incredible deal of a lifetime. So number one is that in our Asset Fund 2, you get access to monthly cash flow. Most investors are going to tell you that cash flow is king. These are also, whenever I refer to cash flow numbers, I'm also referring to what some investors would call cash-on-cash returns. This is the income that these properties are producing on a monthly basis, not from some future equity growth, not based on some future sale, but it is actual revenue being generated on a monthly basis from the rental income that we are getting from these properties. And so just to give you an idea, in the St. Louis Cincinnati portfolio that we're acquiring, they are actively already earning $350,000 a month in rental revenue already. And so we're acquiring them at that basis and bringing that in to our portfolio. So for you as an investor, we are projecting right now in Asset Fund 2, 8 to 10% cash-on-cash returns. Those are annualized rates of return. So you look at 8 to 10% returns on an annualized basis, paid out monthly. And this is a huge opportunity for you. If you are looking to grow your passive income in 2026 based on real assets, real performance, this is the income that you want to look for. And so again, this is based on true rental income. It's not based on anything ethereal or anything out there, based on real hard assets and the income that they are producing. And so get in 8 to 10% cash-on-cash returns paid out monthly to you, the investor. That's reason number one to get in on this portfolio deal. Reason number two is the long-term equity growth. So within this fund, we are projecting a total of a 2x equity multiple over the long course of this deal. And so to explain that maybe a little bit further in depth to those who might not be familiar with that jargon, right? A 2x equity multiple is basically saying, hey, if you've got $100,000 that you want to invest in this fund, we are going to 2x that equity investment that you've made over the course of the investment period, which in this case it's a 3-year investment period. So our goal is, with the 8 to 10% cash on cash returns generated, plus the appreciation that we're going to see in the value of these homes over that 3-year period, you're going to be seeing a total of a 2x equity multiple over the course of that period. And you may ask yourself, well, how are you projecting that? How are you projecting that type of equity growth? Well, in our current model, the way that we increase the value of homes is through renovations, right? And so let's say you purchase a home. We're purchasing most of these homes at a basis of around $100,000. You put in $20,000 worth of renovations to that home, so you're all in at $120,000. And then on the other end of it, let's say that it appraises for a value of $150,000. So that means that whenever you go to sell that asset, that means you have an additional $30,000 worth of equity baked into that home, so that when we sell that product, we get to then give that equity return back to you, the investor, obviously split 50-50 with our team here as our management split. But that equity growth is baked in as we renovate these homes and add value to these homes over the course of the investment period. So this is huge, because if you're familiar with investing at all, the appreciation of assets, the equity growth that is sometimes occurs is very ambiguous and honestly nebulous in other investment types. So just for example, let's look at a couple of other common investment types that are out there, right? You've got people who invest in silver and gold, hard minerals. Great investment, but what it is based on is the valuation of said gold or silver, right? So as people have determined that gold has become more valuable over the years, it is on paper worth X more in percentage than it was 5 years ago, right? Nothing wrong with that. It's just that it is based on a ambiguous reality, not on some true basis of its investment amount. The same goes for venture capital firms. So, for example, the other week I was listening to a presentation from some defense companies who are venture capital firms, and so venture capital firms get valuations based on the intellectual property that they hold. So, for example, if you've developed a new missile type, or even maybe potentially just a piece that goes on a missile, companies will basically purchase you or value you based on that intellectual property that you have created versus the actual value of said technology, right? So again, nothing wrong with investing in that venture capital, that defense venture capital. It's just to say that it's based on a valuation, not necessarily a true reality of what it's worth. Final example is the stock market, something that many Americans are invested in. Whenever people are investing in companies, say Apple, people are, again, putting more money into those stocks based on their perceived value of that company and how it is performing. And the value of that investment can drop based on investor sentiment. Whenever just people decide to sell because they've decided Apple is no longer valuable, they just sell the stock and it goes down, right? Real estate, and especially value-add real estate like we are investing in, is different. And here's what I mean by that. Again, in our case, what is adding value to these homes is true, tangible assets. So we're taking electric in homes that is outdated, and we're adding modern electric. We're taking roofs that need to be repaired or replaced, and we're replacing those roofs. we are taking old furnishings such as old appliances or older cabinets, and we're adding modern appliances, modern cabinets. And those immediate, tangible improvements to that home add immediate value to that home based on tangible changes, not based on some ambiguous valuation by some third party. And so, all that to say, our way of adding value to your equity is meaningful. It's based on tangible changes that we are driving through renovations, not based on some hopeful wishing that, hopeful wishful thinking that it's going to increase in value in the future. So your equity growth is sound and is going to increase as you invest with our team. Thirdly and finally, you need to consider the tax benefits that come with investing in real estate. The tax benefits are huge. And so it largely comes to you, the investor, through depreciation. And depreciation, again, just to put it in simple terms, is the tax code that the IRS provides to real estate developers such as ourselves to be able to write off essentially some of the costs of some of the values of some of the things within homes, because they are going to depreciate in value over time. So, for example, again, just to use some of the examples I used earlier, if you add appliances to a home, you're working on a particular schedule in which that stove, for example, is going to depreciate in value over time. And what the IRS allows you to do with bonus depreciation is essentially say, hey, we know that this stove is going to lose value over 30 years, and so we are going to write off that expense on the front end, which allows us to have the tax benefits on the front end, which allows us to invest that money into those new appliances on the front end so that we can add value to the home, add value to people within this home while having the tax write-off as an incentive to help us in that process. So again, just to keep it simple for you, the investor, what that means is that you can write off some of the amount that you've invested with us through depreciation. We do all that automatically for you through our accounting team. And we're projecting that in year one of investing in this deal, you're going to receive between 50 to 60% depreciation. So again, to put that into tangible numbers for you, if you invest $100,000 into our asset fund 2, we're looking to give you $50,000 to $60,000 worth of tax write-offs that you can use to offset capital gains taxes, any passive income that you have received from 2025. And you can even bank that into future years if you don't have anything that you need to write off for this year. And so, again, I say this not as a tax expert, but as simply educating you on our investment opportunities. If you have further questions on that, feel free to reach out to me. I'd be more than happy to answer your questions. But also consult with your tax professional and learn more about your particular tax situation that way. So again, these are the reasons why you should invest with us in this deal right now. You're getting regular cash-on-cash returns paid out monthly, long-term equity growth based on real, tangible valuations, and tax write-offs through depreciation, allowing you to be set up for success in 2026 and beyond. I'd love to discuss this deal with you in further detail and help you be set up for success. Reach out to me. My number is 682-708-9526. In the show notes, we'll also have linked to my calendar so that you can book a time with me to learn more about how you can start investing with us now, and would be more than happy to start that conversation with you. Thanks again for joining us on the Brick by Brick podcast, and we'll see you next time.